Hi, I'm Sean Pat, CEO of Atala Tools and professor at UCLA, where I teach personal finance, entrepreneurship, and portfolio management. Today, I'm going to talk to you about an option strategy called a zero-cost collar. This is a strategy that's used when you own an asset and you want to hedge against downside risks, and you're willing to give upside returns. So first, we're going to cover call options, make sure you understand the fundamentals. Then we're going to include put options because the strategy for a zero-cost collar includes both a call option and a put option. Then I'm going to show you the payoff diagram for the strategy. And then we're going to go over to Atala Tools, where we have a tool that can show you upside and downside calculations for the strategy. A call option is a financial contract that gives the holder or buyer the right but not the obligation to purchase an underlying asset at a predetermined price within a specified time frame. So for example, suppose Apple shares are trading for $152 per share. Instead of buying shares, you pay a $5 premium per share to buy a call option on Apple shares with a strike price at $150 that's set to expire in 1 month. If Apple's stock price climbs to $160 by the end of the month, the intrinsic value is 160 minus 150, or $10 per share, representing the inherent profit in exercising or selling the option at that time. A put option is the opposite of a call, where it's a contract that gives the holder or buyer the right without the obligation to sell an underlying asset at a predetermined price within a designated time frame. So for example, suppose Tesla shares are trading for $195 per share. Instead of shorting shares, you pay a $10 premium per share to buy a put option on Tesla shares with a strike price of $200 that's set to expire in 1 month. So for this option, if the price of Tesla falls to $180 within that month, the intrinsic value is $200 minus 180, or $20 per share, representing the inherent profit in exercising or selling the option at that time. A zero-cost collar includes the following components. First, you own the underlying asset, so for example, a stock. First, you purchase a put option to protect against downside risk in that asset, and then you finance the purchase of the put option by selling a call option with a higher price against the owned asset. The objective is to protect against downside risk while minimizing or eliminating upfront cost. You want to limit potential losses and potential gains within a predetermined range. Your maximum profit will be achieved if the underlying asset closes at or above the higher strike price at expiration. Your maximum loss will be limited to the difference between the purchase price of the underlying asset and the strike price of the purchased option. So here's the payoff diagram for the collar. So for example, company ABC is at $100 per share. You buy the put option with a $95 strike for $2 per share. You sell a call option with a $105 strike for $2 per share. Here's the payoff diagram, which has including premium. Your maximum gain will be the high strike price less the stock price. So in this example, using $105 strike minus $100 stock price is $5. So we'll achieve a $5 gain at $105 or higher. Our maximum loss is the low strike price less the stock price. So here we have $95 minus $100, is $5 per share. So our maximum loss is $5 per share, achieved at 95 and lower. But we cannot lose any money below 95. This strategy will be profitable at ranges of $100 and higher. So what does this mean? Let's go illustrate this strategy at Atala Tools. So here we have the collar calculator, and we're using company ABC that is trading at $100 per share. So this tool doesn't require zero cost collars, but we're going to illustrate the zero cost. So our short call strike, our long strike price is going to be $95 per share, and that's at $2. Our short strike price is $105 per share, and that has a $2 premium as well. We click submit, and now we can illustrate this collar. So there is no net premium because we've done the zero cost collar. And now we've got our payoff diagram, which shows that the most we can make is 5%. At 105, the most we can lose is 5% at 95. So zero cost collars help you lock in your current price. So in summary, options are a two-sided contract that give the holders or buyers the right but not the obligation to buy in the case of a call or sell in case of a put, an asset at a predetermined price within a specified time frame. Zero cost collars provide the holders of a stock or an asset a way to protect against downside risk without additional costs. The upside is capped at the strike price of the call option with the higher strike price. Always consult with a financial advisor for optimal decision making. And if you want to learn more, come to Atala Tools, where we have a chapter in our textbook devoted to learning about options. So remember, investing is not easy and there's plenty of risk. When you bring options into play, you bring in leverage, but zero cost collars are a way for you to reduce risk. If you want to learn more, come to Atala Tools, where we provide the education and tools to help you on your financial journey.